Powell's speech hints at why did the market react so strongly? The latest interpretation is here. Today's global focus is undoubtedly on Jerome Powell. He delivered his final speech at the Jackson Hole Economic Symposium during his term, and the market reacted with extreme volatility. But why did the market react so strongly? What exactly did Powell hint at? And is the market possibly overinterpreting things? Hi, I'm An, a professional investor who has been focused on U.S. stock investments for over 10 years. Today, I will guide you through an in-depth analysis of the current U.S. stock market, Powell's latest remarks, and the future direction of the Federal Reserve's monetary policy. Before we begin, please give a like, subscribe to the channel, and turn on the notification bell so you won't miss any of my videos. Today is undoubtedly the most eventful day since April 2nd, Liberation Day. All eyes were on Powell's speech at Jackson Hole. This speech not only represents the Federal Reserve's judgment on the current U.S. economy, but also directly impacts the future direction of interest rate policy. Will there be a rate cut in September? Will they remain on hold? Or will they be forced to hike rates due to a resurgence of inflation pressure? All the clues are hidden in Powell's speech today. Next, I will break it down point by point. As usual, Powell took the stage at 10 a.m. Eastern Time. Historically, the Jackson Hole Symposium has been a barometer for the Fed's future policies, and the chair's speech provides an analysis of macroeconomic data, signaling the Fed's latest understanding of the economy. This is a crucial window for managing expectations. For instance, in 2022, when the market doubted whether rate hikes would be too aggressive, Powell emphasized the Fed's determination to fight inflation. In September, the Fed raised rates by 75 basis points in one go. In 2023. Powell shifted to a more cautious tone and did not continue with hawkish rhetoric, but expressed a more dovish attitude. The Fed then chose to hold steady in the next three meetings. Last year, Powell signaled a shift and initiated a rate cut cycle. In just 3 months, the Fed had cut rates by 100 basis points. A significant move. This year, the situation is more complex. High inflation, the impact of tariffs, a cooling job market, an uncertain economic outlook, and constant political interference from Trump have all placed immense pressure on the 72-year-old Fed chair. Next, I will break down Powell's exact message today and show you whether the market's wild reaction is based on rational thinking or emotional overreaction. Alright, if you want to stay updated on the Federal Reserve's policy shifts, Wall Street capital flows, and the stories behind the tech giants, remember to like, subscribe, and leave a comment. Your support is the greatest motivation for me to continue producing deep analyses. Now, let's dive into today's topic. Right from the start, Powell dropped a bombshell. The risk balance the Federal Reserve faces in achieving its dual mandate of employment and inflation seems to be shifting, which may require us to adjust our policy stance accordingly. As soon as he said this, the market went into a frenzy. Powell almost replicated last year's script. He started by giving the market an unexpected surprise. The key phrase here is adjust our policy. Why is adjusting policy so crucial? Because the Fed's current policy is still in a restrictive state. Under this framework, any rate cuts must be cautious and limited in scope. The reason is simple. The Fed's primary task remains to suppress inflation and prevent the economy from overheating. But when Powell says adjust policy, it suggests that the Fed is likely to gradually shift from restrictive policies to a more neutral stance, or even move toward an easing policy. Once the policy stance changes, the Fed will no longer be bound by high interest rates, opening the door for rate cuts and allowing for more flexible and substantial actions in the future. This not only completely alters market expectations for the September FOMC meeting, but also extends investors' imaginations to the fourth quarter of this year and even into the entirety of next year. Immediately after, Powell shifted the topic to the labor market, which was the second key point of his speech today. Powell pointed out, overall, the labor market is in balance. But this is a peculiar balance caused by both labor supply and demand slowing down. What does peculiar balance mean? Simply put, while the demand for hiring from businesses is cooling down, the number of job seekers is also decreasing. As a result, the unemployment rate remains stable on the surface, giving the appearance of balance. But this balance is actually very fragile and even dangerous. If this delicate balance is disrupted, such as when businesses shift from slowing down hiring to actively laying off employees, the unemployment rate could rise dramatically, potentially leading to a sharp spike. Powell's underlying message is quite clear. The Fed cannot wait for the unemployment rate to rise significantly before taking action. Instead, it must preemptively lower interest rates to support employment and the economy. Therefore, the market's interpretation is that even if inflation data occasionally fluctuates, as long as this peculiar balance persists, the Fed will be more inclined to lower rates to ensure the labor market and the overall economy achieve a soft landing. Friends, this is the biggest highlight of Powell's speech today. On one hand, he signaled a potential policy shift, And, on the other hand, he highlighted the risks in the labor market. This is why the market reacted so strongly. After discussing employment, Powell turned to inflation and tariffs. He clearly stated that the impact of tariffs is more of a one-time jump in price levels, whereas monetary policy is truly concerned with whether this price increase will evolve into a sustained inflationary risk. This led to the third key phrase of his speech: one-time vs. sustained increases. Firstly, this was Powell's first clear definition of the impact of tariffs on prices as before this, he had repeatedly emphasized that tariffs were a significant and highly uncertain upward risk to inflation, and the Fed had to remain vigilant. However, his current statement contrasts sharply with his previous, more vague and cautious remarks. While he still left room for the possibility whether this will result in a sustained increase in inflation still needs to be observed. This shift in tone is highly notable for the market. Then, Powell introduced a set of data on supercore inflation. Supercore inflation refers to inflation excluding the direct impact of tariffs. Powell noted that while tariffs have indeed pushed up overall inflation and core inflation, supercore inflation has notably slowed. This suggests that the current inflation structure in the U.S. has clearly differentiated, providing data support for his definition of tariffs as a one-time shock. However, he also warned the market that one time does not mean it will disappear immediately. The impact of tariffs may take longer to fully digest, and both its breadth and depth need to be evaluated. If tariffs ultimately evolve into a sustained, structural price increase risk, the Fed will not sit idly by. Powell also mentioned that the constantly adjusting tariff policies might prolong the price adjustment process. Regarding the future direction of inflation, he provided two scenarios: the wage price spiral, where wages push up prices, and prices in turn push up wages, ultimately leading to runaway inflation. But he immediately added that, given the current delicate balance in the U.S. labor market, the probability of this scenario occurring is low. The more realistic possibility is that inflation expectations rise, pushing actual inflation higher. He emphasized that, at present, both market and survey data show that long-term U.S. inflation expectations remain firmly anchored at the 2% target, with no signs of runaway inflation. If you agree with my analysis, don't forget to like, subscribe to my channel, and share your thoughts in the comments section. Finally, Powell made a strong commitment. No matter what happens, the Federal Reserve will never let a one-time price level increase turn into a sustained inflation problem. This statement conveys three key messages. First, the Fed's future decisions will remain highly flexible. If tariff risks spiral out of control, they can quickly turn hawkish. Second, serves as a preventive shot to the market. Don't become overly optimistic just because of one-time inflation shocks. Third, it's a warning to the Trump administration. Trade policies can be pursued, but if they become too aggressive and cause inflation imbalances in the U.S., the Fed will not hesitate to take tightening measures, even if it means sacrificing economic growth. This speech was not only a major signal to the market, but also a strategic layout for future policy space. For investors, understanding the difference between one-time and sustained inflation is crucial. If you find today's analysis valuable, remember to like, subscribe, and leave your thoughts in the comments. Lastly, Powell announced that the Fed would revise its monetary policy framework, abandoning the average inflation targeting approach set in 2022, combat low inflation, and instead returning to a clearer, long-term 2% inflation target. This means the Fed is officially lifting to a more flexible policy stance. The Jackson Hole Symposium has now concluded, and Powell has almost clearly signaled an interest rate cut. However, this time, the tone is far more dovish than the market had expected. Does this hint at sharper issues beneath the surface? Wall Street's views quickly became polarized, roughly dividing into two camps. The optimists believe Powell has clearly signaled a policy shift, placing job preservation above fighting inflation while actively downplaying potential inflation risks. This effectively removes the biggest policy uncertainty for the market and officially kicks off a new round of easing. In their view, investors should decisively embrace risk assets. The cautious camp, however, warns that Powell's dovish stance actually stems from deep concerns about an economic recession. They argue that while the Fed is downplaying inflation, it is also taking a risk. Future rate cuts may not be a sign of a market reversal, but rather a signal of a hard landing for the economy. In other words, the current market euphoria could very well be a trap. Owen believes that this speech is highly significant for the future direction of the U.S. stock market. Previously, the biggest concern for the market was whether the Fed would hesitate to act due to the inflationary pressures from tariffs, potentially dragging the U.S. economy into unnecessary downside risk. But now, the situation has changed. The market is no longer concerned with whether the Fed will cut rates or how many times, but with a more direct question: will the U.S. economy face problems? Powell has already hinted in his speech that if the labor market can't even maintain basic balance, the U.S. economy could face more serious consequences than anticipated. This suggests that the resilience of the U.S. economy may not be as strong as previously thought. Moving forward, the non-farm payroll data will become extremely important. If it falls significantly short of expectations, it would signal that the U.S. economy is in worse shape than the market has realized. Even if the Fed takes more aggressive rate cuts, it may not be able to alleviate the market's concerns. This represents the biggest risk that must be monitored in the short term. Finally, OAN wants to remind everyone, while the market's reaction is worth celebrating and Powell has indeed provided clear rate cut expectations, the ultimate policy implementation still depends on the data. If future economic data doesn't meet expectations, such as inflation making an unexpected rebound, the Fed will not cut rates according to the set path. From Powell's speech, it's clear that he has left room for flexibility, and this is something to pay special attention to. So, what do you think? Is Powell's dovish stance the beginning of a new bull market or a dangerous illusion of prosperity? Feel free to share your thoughts in the comments. Lastly, as usual, let's do a weekly recap. On the macro level, the core driver of the market this week was undoubtedly Fed Chairman Powell's dovish pivot at the Jackson Hole Symposium. He clearly stated that the risk balance in the U.S. economy is shifting, and the downside risks in the labor market are now enough to warrant a policy adjustment. He also downplayed the long-term impact of tariffs on inflation. This statement completely reversed market expectations. The probability of a rate cut surged from 70% to over 90%. As a result, on Friday, the three major US stock indices rebounded strongly, ending their previous 5-day losing streak, with the Dow even hitting a new all-time high. At the same time, USTREA-SURY prices surged, with short-term yields falling by about 10 basis points, the U.S. dollar index dropping by 1%, and assets like gold and Bitcoin rising. It can be said that despite other Fed officials issuing hawkish signals earlier in the week, Powell's speech ultimately dominated market sentiment and gave a strong boost to risk assets. That's it for today's analysis. Friends, if you found Aeon's insights helpful, don't forget to like, subscribe, and leave your comments. Every bit of support is my motivation to continue providing market breakdowns. Thank you all, and I'll see you next time.